British inflation hits 2%, but services inflation remains stubbornly high. All eyes now are on the Bank of England tonight. Indonesia's central bank is set to hold rates, while the Bank of Japan's board minutes show growing concern there over a weak yen. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Head of G3 Economics, Brian Martin, explains why wage growth and services inflation have seen ANZ pare back its 2024 ECB rate cut expectations.
It's just going to stay that little bit stickier and that little bit elevated in the short term, and that means that the ECB just proceeds that bit more cautiously over the next 6 months in terms of interest rate cuts.
But first, in 5 and 5 with ANZ. Global markets were quiet overnight because there's a public holiday in the United States. The Aussie dollar was trading up 0.25% at 66.72 US cents at 4 a.m. Sydney, Melbourne time, and the Kiwi down 0.2% at 61.3 ahead of GDP data later today. In the UK, annual CPI inflation hit the 2% target mark in May. However, traders focused on services inflation at 5.7%. That's well above the Bank of England's staff estimate for 5.3%. Here's ANZ economist Bansi Madhavani.
Services prices are likely to moderate in coming months as labour market comes into better balance, and on those bases we believe that conditions for rate cuts should unfold over the third quarter. In terms of market reaction, the pound rose following the release of CPI data as markets pared down expectations of rate cuts. Currently, the markets are pricing around 75% chance of a rate cut by third quarter, and that's down from 88% priced in the day before.
Number 2. Attention now turns to what the Bank of England will do with interest rates tonight. Bansi says a hold at 5.25% is expected, but that the Bank of England faces a complicated task of communicating when it might move later this year.
Ahead of the UK's general election on 4th of July, the Bank of England has cancelled all public engagements except the MPC meeting. Now, this restrains the guidance that the officials will be able to provide about near-term policy direction. In general, we expect the Bank of England will want to flag readiness to cut rates before they begin a rate-cutting cycle, and the way we think that can evolve is that the committee will look for improvements in data over coming months and then signal readiness to cut rates once they have sufficient confidence.
Number 3. Bank Indonesia also makes a rate decision today. ANZ economist Crystal Tan is expecting it will hold at 6.25%, although she's watching out for chances of another surprise hike, as we saw in April.
Considering that the rupiah recently hit a fresh 4-year low and also BI's surprise rate hike in April in response to currency weakness, we do acknowledge there is a risk of another 25 basis point hike today. But that said, we do think the hurdle for a rate hike is higher now. It's worth noting that BI's April hike had come on the back of a shift in expectations for the Fed funds rate following strong US economic data. But this time around, recent US data have shown signs of softening.
Number 4. The Bank of Japan's minutes for April showed concern a weak yen could push up inflation, requiring further tightening. ANZ FX analyst Felix Ryan says the concern was stronger than the governor's post-meeting remarks. There was even talk of an insurance hike to get ahead of further yen weakening.
There was one member who did suggest that moderate rate hikes now could offer some support to the yen again to maybe stop a rapid rise in inflation as a result of a weaker yen, and that would offset the need to tighten policy rapidly later on in the event that a weaker yen or a sharply weaker yen did raise inflationary risks in Japan.
ANZ economist Miles Workman is forecasting a 0.2% quarterly rise. That's the same as the Reserve Bank. He says services industry growth is the key to watch for any clues on the inflation outlook.
Services industries do tend to move a little bit slower than goods industries. So what we're all really looking for in these data is evidence that the services side of the economy is slowing, catching down to the goods producing side is one way to phrase that, which would have, if we do see that, it kind of gives us a bit of confidence that those sticky services inflation risks are being mitigated.
Miles Workman there. Now, in our bonus deep dive interview, ANZ Head of G3 Economics, Brian Martin, tells my colleague Alex Tarrant why he has reduced his expectations for how many further rate cuts the European Central Bank will make this year.
We've dialed back our expectations for ECB rate cuts in the second half of this year to 2 25 basis point rate cuts from 4 25 basis point rate cuts. And the reason for that is very straightforward. Inflation in the early stages of this year has been that little bit firmer. But I think from a dynamic of how inflation is going to unfold over the remainder of this year, the one piece of information that we did get that sort of changed the goalposts a little bit as far as we were concerned was the acceleration in negotiated wage settlements in the first quarter of this year to 4.7% year-on-year from 4.5% year-on-year. And they came out at the end of May, just before the ECB meeting. And whilst they largely represent, or the acceleration largely represents, compensation and one-off compensations for previously record high inflation, it has still just meant that from a wages perspective, service inflation is likely to be that bit stickier, and that's why we've changed our view.
And so what are you expecting for services inflation now?
Well, I ran some calculations, and it runs between 3.8 and 4% over the second half of this year if the monthly increase is 0.25% month on month. And that actually could be an optimistic view on services inflation in the short run. So I think the risks are that services inflation is just going to stay quite bumpy, is the word the ECB like to use. But I think it's just going to stay that little bit stickier, that little bit elevated in the short term. And that means that the ECB just proceeds that bit more cautiously over the next 6 months in terms of interest rate cuts.
Are there any countries you're looking at or worried about the most in terms of that wage growth?
It largely came in Germany. The public sector workers in Germany got a €1,920 one-off payment earlier this year to compensate for the high inflation that they experienced in the aftermath of the pandemic and the outbreak of the war in the Ukraine. So that's one area that I think we have to look to. But I've got to say, the incoming data that I can see is pointed to a moderation in wage settlements. And that's mainly the Indeed 3-month jobs data on wages that we get. The ECB also tells us that its wage tracker is showing that incoming wage data is moderating. So if I run our framework for euro area inflation, particularly services inflation of 0.25% per month, into the first half of next year, it starts to drop much more precipitously. And you get, on that calculation, services inflation dropping down to 3% from around 4% at present by the middle of next year. And I think that's going to be music to the ECB's ears and allow them to cut interest rates in a more pronounced fashion. In fact, over the cycle of rate cutting, I'm anticipating a 200 basis point reduction in the benchmark deposit rate from 4% to 2%.
And Christine Lagarde was sort of quite firm in the recent press conference of people not to get ahead of themselves as well. So this all seems to be fitting in together with your call.
I think that's right. I think what the central banks don't want to do is to engender expectations of rate cuts when in fact they're really data dependent. So they don't know, the central bank doesn't know what the data is going to be. It's got a forecast track for inflation, but it doesn't actually know what the data are going to be itself. So it wants to wait patiently and see what the incoming data is before deciding again. And just try to stop markets from running ahead of itself. That means that hopefully monetary conditions don't ease too fast, too quickly, which could reignite inflation. But it also means that markets don't get ahead of themselves, and therefore hopefully you won't get the disruptive volatility in financial markets that can affect economic activity. So I think it's a very sensible approach to be saying, look, we are data dependent. We've set out a very clear framework for what will be required to cut interest rates in the future. That is our outlook for inflation, the dynamics of current underlying inflation, and the efficacy of the transmission mechanism of monetary policy. And as long as those three are working in line with our forecast procedure, yes, we will cut interest rates, but this is not a sprint. This is a marathon, and we have to get it right.
Brian Martin there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, June the 20th. Catch you tomorrow with what the Bank of England does with interest rates and a review of New Zealand's GDP data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.